You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time to rock out with your favorite band of Option Block All-Stars. Yes, it's time for the old OB. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you're saying to yourself, what is this OB he speaks of? I know a lot of newcomers coming in all the time. First off, welcome. Secondly, you're a little bit late to the party. We've been doing this for a while, but we welcome newcomers nonetheless. The party is always going 24/7, or in this case, twice a week, every Monday and Thursday, 3 p.m. Central, 4 p.m. Eastern. You know, we may play around with that time a little bit, which I know is heresy. It's been going that time for a long time, but we'll see. Maybe some details on that forthcoming. Of course, you can always get us live via Mixlr whenever we go live, as well as some other fun stuff hitting that Mixlr feed for you this week. Did a little OPR in there this week. Had some interviews in the studio talking crypto and Bitcoin, all sorts of fun stuff. So it's not just option blocks, not just vol views, not just TWIFO. There's other stuff hitting that feed throughout the week. So keep an eye on the Mixlr. Subscribe if you haven't already. Follow us on Mixlr. And then you'll get notified when we go live with a bunch of fun stuff throughout the week. You never know what's going to hit you throughout the week. So keep an eye on the old Mixlr. And, of course, however you listen live after the fact, podcast, website, mobile app, wherever you get it, make sure you hit us up. Questions, comments, insights. We do enjoy hearing from you folks out there. And joining me on the old program today, let's spin the old option block dice. They are indeed 20-sided, the best kind of dice indeed. And let's see who we got. First off, we're going out to a little quiet, sleepy hamlet known as St. Charles, Illinois, where we are joined by none other than the Uncle Mike Tosaw from the appropriately named St. Charles Wealth Management. Uncle Mike, welcome back to the show. And once again, congratulations on just your great fortune of having landed St. Charles Wealth Management indeed in St. Charles. What are the odds?
No kidding. And you know what? And the 20-sided die, I won in 20-1 odds. I'm excited about that. And are you down with OB? Yeah, you know me.
Yeah, it was actually a natural 20 for all of you hardcores out there getting Uncle Mike on the show. So here we go. Uncle Mike rolling a natural 20. I think that bodes well for our auspices for the rest of the show. Let's see if we can keep the luck up. Of course, you never know when you go out to this crazy place. It's full of diehard cynics and libertarians and crazy lobster fishermen and all sorts of other stuff. It's called the land of Maine. And we are joined from the wee part on the edge by the coast by a man known as the Rock Lobster, Mr. Andrew Giovinazzi from OptionPit.com, by way of a little bit of Carmen line out there. Mr. Giovinazzi, welcome back to the show. How go things in that principality, nay duchy, nay kingdom known as Maine?
Very well. We had a lot of visitors here today. We had like 15 people show up, come in and out. So
in the state of Maine, you had 50. That's a lot in that state of Maine. You're right.
No, in the compound, as people walking in and out and around and doing all kinds of summer activities in Maine. So summer is here, and when summer is here, people coming down my driveway and visiting. So that's what happens. They visit, they drink soda pop, they jump in the water, and then they leave.
Yeah, we don't really have that in downtown Chicago. People show up on your doorstep, you call the police or you shoot them. So there's not a lot of that to coming by to borrow sugar here. Maybe got people swing by the studio a lot, so we have been busy with that this week. So maybe we'll take that as our visitors for the week. Lots of visitors in the old studio, but we got to keep on rolling. It is time, indeed, to get into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome back to the old Trading Block, the portion of the show where we break down what the heck's going on in these here markets that we got here today. And another weird one, in case you're paying attention, and you probably are, playing along with the home game. We're almost a week into the old trade war now, and if you haven't paid attention, it's pretty much been a nonstop bullish rally palooza ever since we announced the actual trade war. So if you were playing along in the home game back earlier this year when the first rumors of the trade war surfaced, a lot of scary, a lot of vol coming back into the marketplace, a lot of sell-offs. Trade war arrives, and it's been 1% rally after 1% rally, or pretty much close to it. Just about every session. So it's been impressive to watch the amount of upside that's been going on. Today, of course, being no exception to the rule, S&P, the Dow, and the tech-heavy NASDAQ all up pretty strong. The tech-heavy NASDAQ leading the charge up today, up about over 1.5%, 1.6% on the day. So tech just feeling the love out there. Dow coming in number 2, almost up a full percent, and S&P quite the laggard, only up 0.8. How dare it only move up 0.8% given all of this just bullish enthusiasm out there in the marketplace. Of course, all that green on the broad equity screen means VIX cash coming in a little bit, taking a little bit of a break, perhaps getting back to levels that some of us maybe on the Vol Views program thought it would reach during the holiday there. And it briefly did, and then decided, no, not so much. But now we're back there again, right around the 12.5 level, off a little bit more than a handle out there in VIX land. Since we're talking VIX, let's start there. Mr. Rock Lobster, according to your methodology, I believe we are now in VIX zone -6. Am I correct?
I actually want to say the square root of 144. No, that would be zone 12. So I don't know. The square root of 1. That's how I'm trying to look. I was trying to come up with a really scientific sounding number, but we are actually in zone 1. And this is the zone we have not been able to stay in for the entire year for any length of time. So, an Option Pit Vol newsletter, we looked at some trade ideas to ease our way into the zone, although I could not get it on. It was a combination of buying July puts in VIX and buying August calls, although some of our guys in our program put it on, were pretty clever. I was a little lazy. I was more interested in Microsoft today. But be that as it may, there are lots of ways to put on vol positions in zone 1, because we would stay in it for a while, and then we have this nasty habit of, the market's been blowing up again. So, we trade warded a little bit, but it seems like I don't know who pulled the switch or whatever, but pretty amazing ignoring the trade stuff now. Like, who cares? I guess they're going to come up with a deal, or people are just going to put tariffs on, and they're like, oh, okay. Then it's kind of one of those things where, okay, we're going to go shoot each other, and then see how it is afterward. And then they're like, okay, well, since we both missed shooting each other, maybe we'll sit down and have some kind of a conversation. So all I'm looking at vol. I'm looking at, and something I teach, my clients in our classes, is I'm looking at per strike volatility today in the SPX. Where is it going and what is it doing? One of the things I didn't see when we had the sell-off this week is, even though VIX went up a little bit, there was really no lift in volatility on the downside. It kind of the curve absorbed the move and didn't do anything. So there wasn't a lot of worry. And if I'm looking at, let's say, July right now, and I'm looking at the July 20, which is the next serial expiration for VIX, for SPX, still, and they're active. The actually strike from the close yesterday, well, at least how it's marketed at the end of the day, even though VIX is down, volatility of that strike looks like it actually went up a little bit. Curve kicking back in when the market rallies pretty hard, which is normal. Normal that it does that. So everything is in, I would call, a normal mode where the SPX is rallying, the curve is adjusting a little bit for it, and now we sit and we wait and we watch. So again, I would be looking at some vol reversion stuff, the fact that we don't stay in zone one. It's kind of one of those things where we stay here and the vol just kind of, we get down to the low 12s or 11 just as things sort of melt, if you have a vol melt, and then you're just planning for the big pop down the road. So I mean, it looks like how sort of the recipe that has been working, at least for the last few months. So I don't expect that recipe to not work. But, we're back to, I believe, VXX lows. So those are future lows. Well, for the let's just call it the 30-day mixed basket of futures. I think this is we're right at the low level of the year before the big the volpocalypse. So what we haven't been able to do is once the basket of futures gets this low in zone one, to maintain it. So if we actually break through this level, then we have something. We could see a lot higher highs, or higher or getting above 2,800, all that kind of stuff. So I think there's a lot of anticipation with earnings, July earnings coming out, over the next 2 weeks. And they're not, so everything is like we're not bidding the vol right now. And I just think the market's looking for good news out of earnings, and the vol shows it, everything shows it. It's just, now are we going to get it? I guess that's what we got to wait for. But I mean, NDX up almost 2% in one day. That's some market cap right there.
And you got a lot of I affectionately term them as crazies in the old pitch chat. What are they excited about these days? I mean, obviously the vol erosion is a big play for a lot of them. So I know a lot of them are knee deep in that. But what's top of mind for them with all this kind of madness going on in the marketplace right now?
Mostly right now, I think a lot of them have been doing a pretty good job of fading every trade. There's a trade war, and you just build a position to fade that. Vol goes back down, market goes back up. Mark's been doing a pretty good job of trading those bounces with, like protected flies and stuff like that. Guys in the chat room just fading the volatility with the vol products, in a what we would call a manageable way. So that's what they're looking at, and anybody just looking at prices like, okay, how high can Amazon go? Okay, who knows? Somebody just put a $500 price target on Netflix, right? $250 is not good enough. So now they want $500. So, or 400 is not good enough. They want $500. So, you look at all that and you go, how high can the Qs go? So I actually am looking at a pair trade for the Qs. Buying Q puts and buying VXX puts, because I'm, it's wow. I didn't think I'd be up so much in my Qs, but there I am. So I don't have a lot to lose by looking at a pair trade. So all of this stuff, kind of put it all together, but a lot of pit chatties, 2,800 time spreads were pretty popular this morning. They paid really well. So stuff like that, where there is actually some upward momentum and, options level bull market. So when the vol's cheap, calls do really well. I think that would be the consensus.
Speaking of consensus, they always reach a consensus out there in St. Charles because it's a happy hamlet. Uncle Mike, sir, what is the consensus on today's activity? What caught your eye, sir?
Well, I mean, a couple things. Just watching the news during the day, you have angry ousted FBI people, angry Democrats, angry Republicans yelling at each other, and the the halls of our nation's capital. So we have that going on today. That was something to see, to say the least. In terms of the markets, tech is obviously what led everything today. But one thing that I did notice is that we did not get, financials were rather quiet today. Now, earlier in the week, they did have a little bit of a rally. But one thing of note is that it seems like financials are in kind of a Missouri mode, the show me state. Financials want to actually, it feels like before financials rally, they want to see what's going to happen with earnings that are going to be coming up, and a lot of the financial giants coming up. So that was another thing that I noticed. And in terms of volatility, we're back to levels that were low enough to where I remember a couple of weeks ago on the show just talking about how I went from being a degenerate premium buyer to a degenerate premium seller. Well, I'm back to being a degenerate premium buyer again. So I think there's reason to buy premium right now in terms of being, if you're looking to buy calls. Of course, you need to find ways to finance it. And as a wise man once said, try and get your juice for free. But definitely I'm leaning towards the side of being a call buyer right now instead of being a put seller. If given the choice between the two of them, I think that's a spot to be at this point in time. And I think that with where we're going, we have a lot going on over with the NATO meetings with the president. And the good news is, and I'm going to give everyone a lot of really good news right now that everyone's going to get excited about. In the next few weeks, we're going to be talking mostly about earnings and not political mumbo jumbo. And that is my exciting bit of happiness for the day.
That excites me as well. And, some things seem to be exciting our listeners out there. Let's see what's got them up in an uproar right now. Uncle Mike, we asked them before the show began, so very, very quickly. Unfortunately, you podcast listeners won't have a chance to play ball. But we gave one of our Thursday option block all-star strategy polls. So if you guys follow us on social media, of course, you guys can still play along and help dictate what Uncle Mike talks about, even if you're not listening live. He gave you guys 4 choices for what Uncle Mike should discuss on his segment of Strategery today. We gave you first choice, premium buying versus premium selling, that old adage. Number 2, theta versus vega. Number 3, pairs trading, kind of getting what Rock Lobster was talking about before. Only this time, options pairs trading versus stock pair trading. Which is better, maybe which is more applicable. We'll talk about that. Or number 4, in the vein of the spirit of urban dance, this time going back to his football days, a 4-3 defense versus a 3-4 defense. Which is better? Which is worse? Uncle Mike, do you want to hazard a guess on what is leading the charge right now?
I will guess what's winning is theta versus vega. That is my guess as to what's in the lead.
Well, you are incorrect, sir. It is actually, let me see here. With number 1 is that old standby, premium selling versus buying. People still want to get it, 43%. Number 2, 29%, the 4-3 defense versus the 3-4 defense. And then we have a tie for third with theta versus vega and pairs trading, both at 14%. So we'll keep an eye on that, Uncle Mike. We'll see if that changes. If you want to dictate what this segment's all about, get in there and vote while the getting's good. This is a short-term poll, only up for pretty much showtime. So get in there, get at it to make your voice heard. Meanwhile, we're going to keep on rolling right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, that funky tune means it's time, I should say, for the funky part of the show, the portion of the show where we break down weird, wild, wondrous, head-scratching paper that's lighting it up across the broad spectrum of options names. Pick some big names. Also like to pick some of the more esoteric names, shall we say, out there, a little bit deeper into the wilds. I'm going to kick things off, though, with a name you guys are probably familiar with. You love it or you love to hate it. This is Tesla. They're making some news today. I guess they hit their 200,000 car quota. So adios to all those great incentives they were providing in terms of tax credits. I think that's getting either mitigated or maybe completely going away. I haven't had a chance to dig too deeply into that. But either way, leaning on the stock a little bit today. Not too bad. We've seen big sell-offs in Tesla before. Today, only 2 1/4 handles, or about 3/4 of a percentage point, closing a little bit shy of 317 out there on the day. As for what we're looking at out here, excuse me, I got some people lighting me up here in the old chat, but looking here at our old friends, the catastrophe puts, the long-term mystery puts, call them what you will out there in Tesla land, but we're back at it again. The Jan 2019 50 puts. Were they lighting it up today? Usually a sell-off day gives these things a little bit of juice, but they're kind of agnostic. They go up regardless of whether the stock's going up or going down. Probably because, as we've alluded to before, they're probably linked to a lot of CDS selling paper out there in Tesla, in which case they don't care if it's moving up a few handles. Those things are so rich and so juicy, they can afford to pay right now 98 cents for these Jan 2019 50 puts. And not many went up today, only 57 lighting it up, but it's worth noting 59, we crossed the 59,000 mark in OI this week. So pushing 60K out there. It is amazing to see just how many of these things are open. The Jan par is also looking pretty good. The par puts with about 28,000 contracts open on the strike, a couple hundred going up today, but still open interest-wise, these long-term puts still just dominate the Tesla options charts. Let's go a little bit farther out. Some people like to play a little bit farther. They say, 2019 is not enough time for Tesla to go belly up. Let's go to 2020. And the 50 puts out there in 2020 doing about 104 today. So light day on the far out of the money put side. No 1,000 lots going up or anything crazy like that. Worth knowing, though, almost 21,500 open on these Jan 2020 50 puts. About 60 going up on the 20 line as well. Also, almost 12,000 open on that strike as well. So you can go do the analysis for yourself, listeners. Go do the top open interest positions in Tesla. You'll see that these far puts continue to dominate the conversation. Since our last conversation, Mr. Rock Lobster, have you guys had a chance over there, Carmen Line, to join the Tesla catastrophe put party, sir?
As much as I want to say yes, we have not, although we are joining the 10 level puts in VXX for a penny. Because I think Mark said we should mention those, because the open interest in those is 200,000 contracts.
Of which you guys are, 40% now, something along those lines? Every time I talk to him, he's buying another 1,000 of those things. And then I'll tease him about it, and he'll go buy 1,000 more.
Well, because you know what? Because if you put up liquidity, you get a rebate on them. So the actual cost is only like 60 cents only. Like a real 60 cents. I mean, and theoretically, VXX, if VXX just decayed on a straight line and there was no more vol pops and just a futures eroded every month, VXX could be easily down $22 to $24 from this level, or actually $22. So that would put you around 10. But all we really need to do, all he has to do is get a nickel out of them.
If you even approach, if you even get anywhere near that, those things are looking pretty juicy. It is kind of funny. Those opening rebates, of course, if people are doing it in the retail accounts, they're not getting all that joy passed back to them. They're opening liquidity for the benefit of others. They're paying full commission rates on those. But yes, you're right. It is nice if you're making liquidity to get a little bit of free activity out there. And I tease, but I think I have a few myself lurking in some of my accounts somewhere. So they're all fun it's all fun and games out there on the VXX 10 puts. And people have been hitting us up about those too. I think we'll be talking about those on Vol Views tomorrow. People just are mystified by those puts. Instead, let's keep on rolling. Let's see what else we got on the old docket today. We got DR Horton Inc. Now, this isn't the tasty donut maker out of Canada. That would be cool. But no, this is a home builder, in case you're not familiar with them. Closing today, or ticker symbol I should say, by the way, DHI. Closing today, $41.66, up about 50 cents or a little over 1% on the day. This is a name that does about 8,200 contracts a day. Today doing 100 shy of 40,000. So a pretty good day, about 5x their ADV. 10-1 calls over puts, because today was pretty much, I guess you can call it a kind of just call palooza out here in DHI. In particular, one strike getting a lot of the love. It was July, not the regular monthlies. It was the weeklies expiring on the 27th. The 42 half calls getting tons of love, getting tons of interest out here, including a big block to kick off the day for 75 cents, going up kind of pretty much exactly mid-market out there. They were kind of a little wide. They were 72 at 79 when this went up. Worth noting on the day, another 10, actually more, about 12,000 having gone up. Total of about 25,000 going up on this strike today. Things went out $1.06 at $1.12 on this rally. So it looks like it probably had some impressive buying paper out here. Looking at the vol out here, that does seem to coincide with this out here as well. It does seem like this was buying paper. Worth noting, no OI to speak of, 56 contracts. So it does seem like this is what it appears to be on the surface. Some very near-term upside love here for DH Horton. Let's go to the charts as we are wont to do, see what's been going on in DHI over the past year that may perhaps warrant such behavior. And a year ago, we were looking at about 36 and a half, 37 bucks. So a little bit shy of where it is right now, but not tremendously so. And then we got up as high as about 53 back in January. And that's pretty much kind of been this vacillation between that level and then back down. It hit 39 recently out there, so it's broken the 40 handle again. So it's kind of had a 10 handle range since January. Our friend here, though, looking like perhaps he thinks the good old days of 42 and a half, or I should say 43 and a quarter when you factor in what he paid for a lot of these anyway, is not too far behind. He's not that wrong. Looking here, it hit that level and beyond. It hit 44 and a half just back in about a month ago, June 13th. So Mr. Rock Lobster, he's in. The clock is ticking. He's got, 15 days for these bad boys to come to fruition. What do you think about someone throwing down 75 cents, roughly 25,000 times for a 2-week play?
Is this a biotech stock?
Yeah, it does. This paper has biotech written all over it, doesn't it? But yeah, it's a home builder. That's what makes it doubly weird.
Is somebody going to buy out a home builder? I mean, when was the last time you saw somebody bid through the offer for calls on a home builder? I guess certainly it may be in 2007. I think somebody is looking for, I think anyway, if that's the right term, aren't they looking for, this is like right on the earnings date. They are looking for a blowout earnings is what they're doing. That's what it looks like to me. They're buying, the earnings are on the 26th. You got July 27. They're either backspreading them, by selling some stock against it. But clearly they think DHI is gonna have a little swing in its step.
DHI is going to become a biotech, at least in the next couple of weeks, it seems like. If this paper is to believe. I should note, by the way, it didn't pay through the offer. It kind of split the market there. So they weren't. It wasn't super aggressive paper, but it looks like it was buying a net. We'll dig in a little bit to see. Maybe there was a little more, but it looks like that 25,000 doesn't appear to have a bias. Doesn't. Otherwise, it could be, your old friend, the overwrite, coming in, which would make a little bit more sense. So getting your 75 cents through expiration if you are indeed an underlying holder. We'll keep an eye on these. We'll mark these in our to be watched category because it's only a couple of weeks. We'll see how these play up going into the earnings as we keep on rolling to our next name. I do believe this is a newcomer to the odd block. This is PagSeguro Digital Ltd, ticker symbol PAGS. Everyone's favorite name. You get up in the morning, you have your coffee, your toast, your bagel, whatever your preference is, and you check your PAGS quotes. Of course, I know what you all do out there. Closing today, 26.35, off about half a buck or about 2%. This is the name that does about 7,000, about a little bit shy of 7,000 contracts a day. Today, doing 81,000, about 15 to 1 calls over puts. And looking here at today's activity, what we saw looked like pretty much a lot of that paper coming from this, what looks to be, Mr. Rock Lobster, a pretty sizable call roll. The Nove 3025 vertical going up, starting the day, looks like about 9,000 on the 25s, 15,000 on the 30s. As the day finished up, we had 37,000 going up total on the 30s and 30,000 and change going up on the 25s. Let's see, the 25s were going up for about $5.30 when they started in that first block of about 9,000, and the 30s going up for $2.90 in that first block of about 15,000. As the day went on, over 2x going up on both of those strikes there. And worth noting, size OI, as you probably would expect, on the Nove 30s, nearly 50,000 open there. So this has all the whiffs of a bit of a roll here. Let's go look and see what PAGS has been up to that could perhaps have indeed precipitated some of this paper. This PAGS is not exactly a shall we say, long-term player, only coming onto our radar here back on January 24th. That's as far as we go back on this one, so a pretty new issue. They got as high, it's like back on January 24th, they were $28. Getting as high since then as almost 40, 39 and $39.97 they hit at one point back in late March. So they have threatened 40 level, kind of been vacillating around ever since then. They're kind of back in the on the lower end of this radar here. So given this near-term sell-off, we saw post the hit earnings, they were about $35 back in May, and then kind of since kind of drifted downward ever since then. So you could see how someone might have perhaps come in on the 30s, and then when they were right around at or maybe slightly out of the money, and then deciding, well, this sell-off, I'm going to take the opportunity to keep the love alive, but roll down to a more relevant strike. Mr. Rock Lobster, your thoughts on that? Are you on board with that? You think this is a roll down, has all the looks, not perhaps a house money roll, but perhaps a roll nonetheless. Worth noting that big block of the 30s going up below the bid, so they probably had to get rid of some, and the 25 is going up above the offer. So that's usually a sign that someone was a little bit incented to get this done. But either way, it does look like someone had some long calls. Let's look really quickly here to see when these 30s were open. Seemed like they traded in a big block. 21,000 traded back on the 7th of June. The stock was a little bit shy of 30, and these calls were about $5 to $6. They had a big range that day. They also traded some more, 15,000 more back when they were about 40. $4.40 to $5 back when the stock was 27.5. So they put on block 7,000. They put it on in multiple blocks. It sounds like they're taking it off in one chunk. Mr. Rocklauser, what are your thoughts here? Rolling to more relevant strike, keeping it alive though in the same month and along those lines, sir.
So you look at this, you're like, okay, PagSeguro Digital, whatever the heck, right? Trading 37,000 contracts in this thing. I don't know. Maybe it's like an owner of the company or something like that, or somebody that has a big stake in it. I've never heard of this company before, but oh my gosh. You don't have your bagel in the morning and check your PAGS quotes. That's what I do every day. I mean, it does look like some kind of a roll. What's weird is it looks like they're trying to close some of their short quarters and buy some 30s or sell some 30s. So I think maybe somebody could be rolling up. Does that look possible to try to keep a buy right going?
So you think the opposite?
It looks like they paid through on the NOV quarters, and the NOV 30s. I'm just looking at time and sales. Yeah, they probably took that up to post them. So
they crushed below the bid and they lifted above the offer on the 25. So I was thinking it as more of a desperation roll down to make the calls more relevant, but it could be the other way. They could take advantage of a recent sell off to perhaps, but then roll into a higher strike on a day like today. I don't know. Interesting. I lean the other way, but hey, maybe our listeners have different views, that's why we like it. That's what makes the market, right?
Exactly. So a very clearly somebody wants to keep it going, and I'm trying to say, so it's kind of fallen from grace a little bit. So maybe they're just trying to keep an aggressive right going. Is that possible? It's a weird one, but dang, it's a lot of volume in a pretty thinly traded stock.
Yeah, it's pretty sizable. They're like doing more than the shares in the options out there. So yeah, it's a pretty sizable day. Whoever they are, they're coming to stay in PAGS because they're going to have to trade with themselves to get out, which looks like that's probably why they had to trade below the bid and above the offer out there. So you talk about liquidity issues, it's felt across the board. You trade these little names, you want to do sides. You're going to have to, shall we say, incentivize the other side to trade with you. We'll keep an eye on this one too. I'll put this here. We got a lot of trades to. A lot of trades to keep an eye on lately. We're going to be doing a lot of analysis post-show here. Keeps us busy. We like it. All right. And last but not least, going back out to the broad side of the space, we're going to go back out to the Materials Select Sector SPDR, ticker symbol XLB. Closing today, 58.61. Kind of slightly unched to the upside. Not a big underlying move day for them. They average about 5,500 contracts a day. Today doing about 23,000. Almost exactly even calls over puts. That's because we had a bit of a weird kind of put call palooza going up out here in XLB. A lot of different stuff going up. We saw some funky prints going up. 27.50 each of the July 58.5 puts and the 58.5 calls going up kind of mid-market, lifting a little bit of the offer on the calls. So it looked like maybe could have been your standard, conversion reversal going up there, shy of 3,000 times. Then we saw more of the 58.5 puts going up for 50 cents just straight up, just kind of lifting the offer there about 7,100 times. And then on top of that, we saw a little bit later, again, these trades were spread out. The other two were a spread, but these were others were scattered throughout the day, so it wasn't all one big spread. It was kind of just a general interesting trend in the overall intraday paper out here. The AUG 60s also lighting it up to the tune of about 7,000 contracts for 56 cents. So I guess if they wanted, well, they were buying the puts there too. So they could be buying a funky strangle and doing it with a lot of time in between. These trades went up about an hour apart. Just an interesting, lot of all over the place paper for a name that didn't really move much today. And I'm looking here, I don't see any earnings going up here, anything like this. Is the spider, obviously, so it's not going to have that. But yeah, there's an interesting plays going up out here. So, and net on the day, what we have is maybe a straddle, maybe a conversion reversal going up on the 58 half strike in July, 2,750 times. And then on top of that, another 7,000 of the puts. So you're talking about 10,000 of the puts going up almost, just naked on their own. And then a little bit later, we see about 6,000, almost 7,000 of the AUG 60 calls going up. Paper gobbling those up too. So maybe a straddle with a funky time strangle going on for an extra kicker, Mr. Rockoff. Total of over 7,000 of the AUG 60s. Worth noting, nowhere near enough OI on any of these strikes to be offsetting any of this paper we're seeing today. So it seems like it's just, you don't see this too often, a funky two-sided put call palooza out here. Let's look at a chart of XLB over the past year to see kind of just what the heck's been up out there. A year ago, they were trading about $55. They got as high as 64 back in late January. We all know what happened in early February. Everything kind of got crushed. And then we're looking here right now, we could say we're seeing about 58 half or so. So yeah, we're pretty much right in the nice middle of that 52-week range. Mr. Rock Lobster, kind of a funky one. Straddle / conversion reversal with another 7,000 puts as a kicker and then another 7,000 calls also as a kicker maybe a little bit later. Time strangle with the straddle? What the heck?
It's what's about this, our odd block today is there's a lot of, kind of funky
One might
stuff.
call it odd.
Oh, yeah. It even feels like pretty large paper. Like just big slingy paper, it feels sort of like. So if I'm looking at this and kind of reading this right, like okay, they're trading a lot of August. Are they trying to write some stuff in July against it with not very much time to go, or they're closing some shorts? It feels like it's all sort of a rolly. Kind of like a funky roll trade. I don't know how else to describe it, to be honest with you. It just feels like a combination of trying to get out of July and into August, and it just feels like they want to be long August, and they switch from maybe like short puts to long calls and try to change their MO a little bit. But it feels like they want to stay long. That would be my guess.
It has, you could read this one any number of ways, which makes it fun, which makes it odd. And what else is odd? I'm looking at some crazy pictures people are tweeting at me. Let's get those off. Those are distracting. All right, let's instead move on down someone operating on a mummy or something. I don't know what the heck that was. All right, instead, let's keep on rolling. It's time for you guys to dictate what the heck Uncle Mike talks about. It is time for the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
All right, Uncle Mike, I'm about to announce the winners of your poll here, sir. It was a hotly contested contest, but the numbers stayed about the same, very close to what they were when we started the show here in terms of percentages. And looks like with 43%, sir, premium selling versus buying is your winner. I know you were hoping that about 30% that wanted the 4-3 defense would come in hard at the end, but they couldn't make it happen, sir. So it's all you. Premium buying versus selling. Have at it.
All right. Well, good to know. One of these days we are going to get something to where I'm going to end up talking about urban dance or the 3-4 defense or something along those lines. But I guess today's not the big day.
It was close. You had about another 10% to go, and that would have happened for you.
We'll see. We'll have to come up with something even more interesting next week just to draw people to it. Like maybe, I already got an idea. So this is what we'll do for next week. History of the WWF Championship from 1984 to 1989. Bob Backlund to the Iron Sheik to Hulk Hogan and beyond.
Ooh, now I'm intrigued. I kind of want to hear that too. Can we just table today's conversation and go straight to that?
Well, let's stick to what the audience wants. Maybe next week. So anyway, premium selling versus premium buying. First thing I want to say on this is that there is no inherent advantage to being a premium seller versus a premium buyer. Now, premium sellers will disagree with me and premium buyers will disagree with me on that one. But from a statistical standpoint, there's no evidence that suggests that one is better than the other. Now, with that, I want to emphasize that for certain situations and certain risk parameters, obviously being a premium seller would be better than a premium buyer and vice versa. But for those of you, I just want to claim umbrage on people, and I know our buddy Don Schlesinger is going to claim umbrage on me with this one, but there is no inherent advantage to one or the other. Now, with that being said, I want to make another point before I get into this. Whenever you make a trade of any kind, whether you're long futures, short futures, long stock, short stock, long premium, short premium, long call, short call, long put, short put, whatever the case may be, you are telling the marketplace that, market, you are wrong and I am right. Let that sink in for a second. You're saying that the whole world is stupid except for me because I'm making this trade. And the only people that are as smart as me are the people that are making the same trade as me. That's what you're saying to the market when you make any type of trade. So let's get into this premium selling versus premium buying. Now, one thing that I always tell people when I talk to new clients about this or at educational events, whatever the case may be, in option trading, there is no such thing as something that is greater risk or lesser risk based upon assuming it's the same amount of contracts. Now, obviously, if you're going to buy 1,000 lot of something versus buying a 1 lot of something, the 1,000 lot's obviously more risky. But by strategy, theoretically, there is nothing that is greater risk or lesser risk. Let me use an example. Let's say that we have two trades. Trade number 1, I just buy stock. Trade number 2, I buy stock, but I buy a put option to protect the downside at the money, let's say. Now, with that, I claim that both trades have equal risk, just a different style of risk. Let me explain this. Now, if you just own the stock, there's no doubt about it that you have more monetary risk. Of course, you have risk from the stock going all the way to zero. And if you own a put option to protect that stock, there's no doubt you have less monetary risk because of the fact that you have the put option to protect you from the strike price with which you bought the put. However, you've shifted risk when you buy the put option and create the married put position, meaning that you've shifted risk from monetary risk, meaning the price of the stock, into time decay risk. So let's say the stock goes to zero. If the stock goes to zero, then obviously you're better off being in the married put. However, let's say that the stock stays the same or even goes up for that matter. It does happen now and then, they tell me. If that's the case, then you're better off just being in the long stock position. So when you buy a put option, you're shifting from monetary risk into time decay risk. So there's still risk in it. You have just shifted the risk. And by shifting the risk in the way with which you did, you're saying, okay, well, I want to have some protection in place, and I think this put option is a fair price to pay for it. I believe that the person selling this put option is a fool. He's a fool for selling this put option, I say, because of the fact that it's providing me with all this protection, and I am willing to pay him that money to have that protection. Now, with that being said, You're always hoping, of course, the stock goes way up and that the put expires worthless and everybody ends up making money. That's very possible. But the bottom line is that you are shifting risk. Now, let's look at it from the other side of it. Let's say that I am a premium seller. Now, if you're a premium seller, let's say that I sold that very put that the put buyer bought. I have a different set of risk. I have the same monetary risk of owning the stock because of the fact that should the stock go to zero, I'm obligated to buy it at the price, the strike price with which I sold the put. However, I get paid for that. And because I get paid for that, that's how my risk shifts. My risk shifts from being that of the stock owner to being that of the put seller. Now, in doing so, I give up a few things. I'm giving up the upside on the stock. If the stock goes up to Bitcoin or FANG levels like those have recently, I don't get to be a part of it. But I got paid. I have shifted risk. I've shifted risk from being the long stock / long put owner to being just the short put seller. And by doing that, I collected the premium for it. Now, how do we shift risk on this again? Well, once again, I am getting an upfront premium. So if the stock stays the same or maybe only moves up a couple pennies, I'm in better shape than the stock owner. I'm in better shape, definitely in better shape than the stock owner and someone who bought a protective put on it. I shifted risk. And that's what premium buying and premium selling is all about. Whenever you have a different sentiment, you can do a premium buy or a premium sell. I talked about a little bit on the show in the strategy block a couple weeks ago about how when we had a greater move in the VIX than the traditional 10-to-1 move that you get when the S&P goes down, meaning that a lot of times if the S&P goes down 1%, the VIX is going to go up 10% or vice versa. Doesn't always happen that way, but that's kind of a very general, oversimplified view on how it can work a lot of times. Now, of course, if you want to learn more about that, talk to the boys at the Option Pit. They'll gladly be able to go into a lot more detail on that than I would. But when we had such a difference a couple weeks ago, I shifted from being a premium buyer to a premium seller. And I went through the strategies and how I manage risk and that type of thing. But I did that because of the fact that I felt that the market was wrong, like I do on every trade that I make, like anybody does on any trade that they make. I believed that selling premium was more advantageous. I believed that the market would not go down to my short put level and that the parameters of risk were more favorable to me being a premium seller at that point in time. Now, let's shift to a couple days ago. With volatility coming down and my in-the-money call making some pretty nice money, I decided that I didn't want to be so much a premium buyer anymore. I wanted to still be a premium buyer, but not as much of one. I decided to shift risk again. So I closed my in-the-money call on SPY, and I opened an out-of-the-money call. Reason being is that we had a pretty nice run on the call option with which I had bought a couple weeks ago. Now, keep in mind, this is after the premium selling barrage. I know I'm kind of getting ahead of myself and haven't gone through all of it. But with that, I decided to shift risk again. Because let's say that the market just falls flat on its face and we go back down to the high 260s, low 270s again, like we were just within this month, then I wanted to have less risk on the table. But if the markets were to continue to go up, I still wanted to have a part of it in some way, shape, or form. So I wanted to be a premium buyer. I believe that volatility is at a lower level right now. I believe it makes a lot more sense to be a premium buyer at this point. My personal sentiment, I could be wrong, as opposed to being a premium seller. I believe the market's wrong. I believe the market's going to have more movement than volatility is dictating that it says it will. So with that being said, the main message that I want to say during this is that there's no inherent advantage to buying or selling options. Yes, there are different scenarios that it makes sense to do one or the other. However, if you do have the personality to where you just can't wrap your brain around being an option buyer or being an option seller, that's fine. But understand what it is. Me personally, I can flip from being a premium seller to a premium buyer at the drop of a hat. However, one thing that I realized many, many years ago is that I cannot be a bearish trader and have success. yes, I believe there's times that you need to stay out of the market, but I've never been able to have success in down markets when I've tried to be bearish. Now, I've definitely saved the bacon many times in terms of staying out of bear markets and being on the sidelines. That's how I deal with my general biases. But with that being said, I know that I have to be bullish when I'm trading. Now, once again, if you're of the school of thought that you just can't fathom the idea of being a degenerate premium seller or a degenerate premium buyer, that's fine. But just have an understanding of that when doing your trading. And that is Uncle Mike's take on premium selling versus premium buying.
All right, sir. Well done. Let's keep on rolling, see if we can squeeze in a little bit of some of the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
All right, everybody, you know the drill. You guys ask us questions. Occasionally, we turn the tables on you, ask you a question of the week every week. This week, we asked you, earnings season coming back up. Trading options during earnings season can be a challenging thing. Some people live for it, others live to avoid it. So what do you guys do? Do you guys hold your options positions through the announcement itself, kind of over the falls there? Or if so, how do you do it? Long premium, short premium, like Uncle Mike was just alluding to? Or do you prefer to just kind of trade around it, before or after the event? Or the whole thing is it just too crazy risky for you? Give you 4 choices. You say, yes, I trade through the event and I go short premium. Yes, I trade through the event and I lean long premium. Nope, the whole thing's too risky. Or I trade kind of around the event, maybe a little bit before, a little bit after, but not during the event itself. Mr. Rock Lobster, we'll start with you. What's your vote, and what do you think our audience is voting for, more importantly?
I think trading earnings before the event.
That's your vote, and you also think our audience is voting for that?
Yes.
Around the event. Interesting. Mr. Uncle Mike, what say you, sir?
I avoid it, but I think the audience is going to say before it.
Oh, so you are trading around as well. Okay, so 2 votes for trading around, and it's still a pretty tight race, actually. Number 1 with 28% is, yes, you trade earnings events and you do it from the dark side, short premium. Number 2, it's actually pretty close, 27%, so 1% behind, is what you guys were saying. They trade around the event either before or after, but not during. Right behind number 3 with 26% is nope, it's just too risky. And bringing up the rear, number 4 with 19% is, yes, I do trade through the event, but I do so in a long premium fashion. Let's see what we got time for here. These are all kind of long questions. The best way to trade, that could take forever to answer that. Fixed time aspect of trading options, that's a long question too. Best way to trade put options, we could fill a whole show with that. There's no quickies here, so I think I'm going to just keep on rolling right on into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, we just talked about it, listeners. It's earnings season. It's coming back. And if you've been waiting, if you've been kind of just waiting by your keyboard and kind of shaking your head as these macro trends blow you hither and yon, then relax. You got earnings season coming up. Maybe you can take your mind off it a little bit. And it's kicking off. It's had some names coming out earlier this week, but it's kind of kicking off tomorrow with a lot of the financials. We got JPMorganChase coming out tomorrow. We got Citibank, got Wells Fargo, we got PNC, a bunch of financials. So if you're into the financials and slinging earnings and trading options around those names, then tomorrow we've got you covered. More names are popping off shortly therein. We got good old Microsoft coming out on the 19th, so exactly a week from today. We've got Netflix on the 16th. We've got Goldman Sachs coming out on the 17th. We've got good old Beamer, good old IBM on the 18th. So a lot of names popping off out here coming up pretty soon, including Apple, Uncle Mike, which I believe is actually coming out tomorrow as well. So you should probably be out there getting ready to trade that tomorrow. But other than that, I'm joking, of course. Uncle Mike, we'll start with you since I was kidding in your general direction. What is catching your eye for the rest of this week into the weekend?
You're forgiven for giving me that heart attack 6 years ago. NATO, 2,800 on the S&P. Trump in England, Trump with Putin in Russia, whatever they'll let us hear. And after that, earnings. Very excited about all those things that are happening. All the political stuff should be over very shortly, and we get to focus on 2,800 on the S&P and earnings in the near future. Very excited.
Very excited indeed. Mr. Rock Lobster, sir, what are you excited for?
I'm excited for earnings coming out, and I'm excited for, you guessed it, we stay in zone 1 for a week, because we haven't done that all year. That's what I'm looking for. Zone 1 for an entire week.
So not zone -6, as I was alluding to at the top of the show.
Less than a 13 handle in VIX.
I'm waiting for the new revision to the zone policy where we have some negative numbers in there. It would make my day, sir. All right, that music means we've come to the end of another epic journey through the world of options. Talked a little bit of VIX, a little bit of Tesla, a little bit of S&P, broad index stuff, a lot of little silly names in the odd block. Talked about how you like to trade options through earnings. Do you or don't you? And looking ahead to when VIX will hit zone -16. Outside of that, let's go back around the horn, see what everybody has cooking that may interest you. We'll start with you, Uncle Mike. If I was very interested in the aforementioned St. Charles Wealth Management, where should I go? What should I do?
Come on by my office, 303 East Main in St. Charles, or give me a call at 312-212-3531. And if you're not able to get to town, visit my website at www.stcharleswealth.com and learn what I'm all about as a financial advisor. Would love to work with you because I am not afraid of the word Vega.
Ooh, that should be on your business card. A financial advisor is not afraid of the word Vega. I know Mr. Rock Lobster is a little bit afraid of the word Vega. That's why he prefers mostly to deal with theta. Don't you bring up Vega in his pit chat. Uncle Mike or Mr. Rock Lobster, when you're dodging all that Vega, aside from that, what else you got cooking over there these days?
We're going to have a fun class on Sunday, the 29th of July. It's like 3.5 hours. It'll be about learning how to fix broken trades, controlling trades, all kinds of short gamma, short Vega trades, and learning how to manage them, adjust them, and not blow yourself out on them. It'll probably be the best course we have ever done on this subject for the general population. So, the normal rule, it doesn't cost you a whole lot more than an 1/8 on a 10 lot, but it sure will be worth it.
3.5 hours. You guys aren't playing. Pack a lunch. Come into the Option Pit seminar. Go to the bathroom ahead of time. There's no bathroom breaks in the seminar, right, sir? It's straight going.
Actually, there's 2 15-minute breaks.
Oh, there are. Okay, well, there you go. So bring a lunch, but you can also take a little bit of a potty break if it is needed. Or you can go the Uncle Mike route and just super high BBI, whatever is up to you. 3.5 hours, pure rock lobster in your ear holes and in your eyeballs. Check it out, optionpit.com. to learn more. And on behalf of Uncle Mike and the Rock Lobster and myself, we'll see you back here on Monday for the option block. But if you are joining us live, you want to hit us up, enjoy some more live showage. Then tomorrow we got Vol Views, noon Central, 1 p.m. Eastern, and TWIFO, 1:30 p.m. Central, 2:30 p.m. Eastern. So pick your poison. You like commodities and all the action, the vol, the skew out there. You want to stick equity and index vol. We got you covered tomorrow for the shows. Otherwise, we'll see you back here next week for more of the option block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.